Hello everyone, my name is Tyler Pedersen, and today I'm going to tell you why you should buy stock in the Walt Disney Company. Currently, the stock price is trading at around $115. According to my discounted cash flow evaluation, I got a price of $141. I attribute this 23% upside to three main factors. The first being the company's ability to integrate Star Wars between its major segments. The second being the country's expansion into China. And the third being that I feel like investors have oversold the stock just because of fears in ESPN and subscriber losses and the cord cutting with streaming. I feel like it's created a buying opportunity for the stock. So to kind of reiterate and give a plan, I'm going to first talk about the Star Wars integration between the segments. Next, I'm going to lead into Chinese expansion and also the Shanghai Disney Resort. And finally, I will go into the investment risks that relate to cord cutting and ESPN. Then we'll open it to a Q&A session. So to start off with the Star Wars integration, Disney is I believe this is one of their biggest competitive advantages, is the fact that Disney can take one company and they can integrate it between their major segments. They can make movies, they can make it into theme parks, and they can offer you the merchandise. They have, I believe Disney, no other company can buy Star Wars and generate as much cash as Disney can. So the first part of the integration is, of course, the movie. While in the US, movies have been around for a while, we may feel like it's a dead industry. Worldwide, it's actually rapidly growing. This provides a great supply for Star Wars. There's going to be many screens that this can be displayed on. Second, the company has also, they own a 33% stake in Hulu. They've also lined up deals with Tencent in China and Netflix in Latin America. These two regions are kind of notorious for pirating films, so locking in these streaming contracts will give Disney access to revenue that they otherwise would have missed out on. So the Star Wars movie has already been adding to Disney's top and bottom lines. This movie is extremely popular. The first kind of commercial debut where they offered ticket sales happened during Monday Night Football. As you can see the spike in Google searches for Star Wars. People love this movie. They wanted tickets. It led to website shutdowns on Fandango, AMC, MovieTickets.com, broke single sale records, first day pre-sales records, breaking records everywhere. The second, Disney can implement Star Wars into their parks and resorts segment. They're already planning on building two 14-acre expansions, one in Disneyland, one in Disney World. This is especially important because Disney's theme parks are incredibly popular. They have roughly double the attendance of the next closest competitor. As you can see, this is Cars Land in the Anaheim theme park in Disneyland. Extremely crowded. What they've been doing to kind of counteract a little bit of this overcrowding is they've actually been raising ticket prices. Ticket prices have doubled in the past 15 years, and people continue to come to the parks. It hasn't stopped. And the best part of all for Disney is the guest spending has also been increasing. Basically, you're inside Disneyland. If you want a bottle of water, you have to spend $5 on that bottle of water. I guarantee you Disney does not spend $5 on that same bottle. They make very high margins. So this guest spending is great for them. And these 14-acre expansions, they're going to be able to sell a lot more tickets. People are going to buy more once they're actually in the park. Finally, the consumer products segment. We've all seen Disney can make anything. They can sell it, sweatshirts, computers, laptops. You can buy anything for Disney. This segment is actually very profitable for Disney. As you can see, the revenue increases and also the margin increases. That's what most important to me, is the fact that Disney does create high-quality merchandise and people are willing to pay a premium for it. Disney also owns 3 out of the top 5 toy licenses in the U.S., as well as 4 out of the top 5 in the world. This has also contributed to that revenue increase, is the power of Disney's franchises. As you can see, Disney is also very good at promoting this merchandise. They launched the Star Wars merchandise. The first time you could buy it with Force Friday, kind of like Black Friday. And as you can see, the toys are all gone. This week was actually so successful for Disney. During the week, 1 out of every $11 spent on toys was spent on a Star Wars toy. This covers not only toys. Disney has expanded their reach, like I was saying earlier. You can buy an R2-D2 Fiat. You can fly on the Disney plane on ANA Airlines. You can dress up with CoverGirl makeup, like your favorite Star Wars character. So that was kind of, basically Disney can do this with every one of their franchises, not just Star Wars. That's the most recent example. They've done it with Frozen, Toy Story, Finding Nemo, and they just released a sequel, and the process starts all over again. Disney is very good at this integration process. So second, a more long-term catalyst. The park in Disneyland has been around celebrating its 60th anniversary. I can see the expansion in China going on for a good part of the next century. One of the big reasons China is important for Disney is just the growth in the economy, and not only growth in the economy, but growth in the middle class. Currently, the middle class makes up around 18% of Chinese population. Analysts expect by 2020, this is going to be around 40%. As you can see, this is translated to an increase in disposable income, which also leads to an increase in spending on entertainment. As you can see, movie sales have been dramatically increasing. It's almost a $5 billion industry, box office revenues in China. More specifically for Disney, not only is entertainment getting more popular in China, but Disney Entertainment specifically. This segment for Disney has been growing at roughly double the rate of the entire company, so it's definitely the fastest growing segment. As you can see, they opened a brand new Disney store in Shanghai, China. This is the largest one in the world. This store was actually forced to close down 1 hour after opening just because of overcrowding concerns. They wouldn't let anybody else in the rest of the day. Also, to launch the new Star Wars movie, they did a big production. They put 500 stormtroopers on the Great Wall of China. This kind of shows that the Chinese population really accepts Disney as well as Star Wars, and they have an appetite for it. So now the Shanghai Disney Resort, I feel like, as I was saying, the Disney Resort has been around for 60 years. The Shanghai Disney Resort could be around for the same amount of time. This resort is going to be huge, almost 1,000 acres, making it roughly double the size of the Disneyland Resort in Anaheim. They're going to have 2 hotels, a shopping center, and also a Broadway theater. This is specifically important because I feel like Disney did a great job in scouting out the location for this. Shanghai, as you can see, the financial district in Shanghai, rapidly growing over the past 25 years. Not only is it rapidly growing in terms of construction, but also in income. Shanghai has roughly double the income than the rest of China as a whole, and this number is still increasing at a larger rate than the national average. So here's a little map. You can kind of see more specifically where the Disneyland Resort is going to be. The government has already announced they're going to build a high-speed train station within walking distance from this park, which will connect the 3rd largest airport as well as the 4th largest airport. Together they combine to make the largest airport in China. So you can land in those airports and get to the park within minutes on these high-speed trains. They go 180 miles an hour. What's also good is that financial district, that's the big dollar sign. Shanghai has a lot of money, and they're definitely able to spend this money on theme parks. So finally, no investment comes without risks. The biggest risk in investing in Disney would have to be the cord cutting. ESPN is a large percent of their revenue and operating income, so any subscriber losses are definitely enormous. I do think this is overblown because ESPN is sports. Most people, 96% of sports are watched live. You're not going to stream them on Netflix. You want to watch the game. And if you miss the game, you're going to watch the highlights. And ESPN has contracts with Monday Night Football, the college football playoffs, as well as the NBA Finals for a good part of the next decade. So I feel like these concerns are overblown and actually created a buying opportunity for the stock. The second is there's high expectations on the Star Wars franchise. If the first movie is not as popular as people, or if people don't like the movie, they're definitely not going to go pay and see the second one, the third one, and buy the toys. So it has to be a good movie. And the last would be the localization in China. They already built the park in Hong Kong, and just now it's turning profitable. Just because the park was too small, they kind of got a lot of Chinese local tastes wrong. And so hopefully with the new park in Shanghai, it's a bigger park, there'll be more to do, and hopefully they can get those local tastes correct. So to reiterate my buy recommendation on the company, valued at $115 today, 23% upside because of the company's ability to integrate not only Star Wars, but all their franchises. It's a great integration model for them that they can continue to do with sequels for many years to come. I also think the expansion in China is very good for them. Disney is very popular in China, and the Chinese economy is the fastest growing in the world. And finally, today is a very good opportunity because it still hasn't recovered. Its all-time high is $122, so it's still held below just because I feel these investor concerns over ESPN and cord cutting and streaming services. I feel like you can still get in at a good price right now. And now I will open the floor for questions.
Great. Great. This is Steve from Citadel. Great presentation, a lot of good detail on news and data points in there as well. I know you did a DCF valuation, but maybe how do you think about the valuation compared to other media companies? You brought up how Disney is the best at extending its franchise and how it has these unique catalysts, but still there's fear in the media industry broadly about cord cutting. So have you done a comparable company valuation analysis, and how does it stack up?
I have not done a comparable analysis specifically for their media segments, just because I feel like it's hard to compare Disney to a lot of companies. They're not just specifically Discovery or Time Warner Cable. I feel like they provide a lot of content, and that's truly why you watch ESPN as the content. It really doesn't matter. I actually have a slide prepared for this question. Yeah, so there's the contracts they have lined up. ESPN has an incredibly large market share, so I do feel like sports kind of gives them that moat over the rest of the competitors. So I feel like if I did do a comparable analysis, I would give them a higher multiple, just because it's sports. ESPN is huge, and also just because the format changes, Disney can still make money off it. The minutes streamed is dramatically increasing. You're still watching ESPN.
Thank you.
This is John from Resonate. Have you taken a look at the underlying shareholder base? How much of the company is owned by mutual funds versus hedge funds? Looked at 13Fs. Are investors underweight this stock in any form? Who's the incremental buyer here?
I haven't looked too much into that. I know a couple of institutions do own Disney. I do know when the stock price got hit down to $96, Disney was actually one of the biggest investors in their own stock. They have currently in 2015, it's a $5 billion stock repurchase program. When the stock was valued at 96 to 99, they actually bought $2.4 billion worth of stock, so almost half of their repurchase program. So definitely the institutional investors will help, but I feel like Disney believes in their own company. So if investors do have this fear, Disney will support the stock.
Thank you.
Okay, yeah, that's great. So thank you so much, all the contestants. Excellent presentation.